The Fed in focus on Wall Street. Nearly 30% of interest rate traders are pricing in the Fed's first rate cut in March. It's according to the CME Fedwatch tool. But Richmond Fed President Tom Barkin saying today he sees inflation being stubborn. And he's advocating for a higher for longer stance on rates. We'll get more insight into the Fed's thoughts tomorrow when we get the minutes from the last meeting. For more on this, we turn to Megan Horneman, Verdence Capital Advisors Chief Investment Officer. So Megan, thank you for joining us. Let's get your take on this. When do you think, Megan, the Fed starts cutting?
I think March is way too optimistic. I think you're looking at a second half of next year, early 2025. And I think you said it, the inflation now is going to be much more difficult to get down to that 2% level where they want to be. It was pretty easy when we cleared up the supply chains and moving past the pandemic to get some of that goods type of inflation taken out of the equation. But now you have that sticky inflation. The three areas that we're focusing on is housing, services, and then wage inflation. And all of these three things are still growing on an annual basis, well above what the Fed wants.
And so then what, Megan? I mean, because the market believes that the Fed is done, and the Fed has done nothing to dissuade the market from that belief. But if inflation isn't coming down, is the Fed actually done?
I actually think the opposite. I don't know why everyone's getting so optimistic on the fact that they can come in and cut rates. They've told us they can't. They've told us they're going to remain vigilant, higher for longer. They haven't done anything to really take a hawkish view out of this. So I think we're back to the same situation we were last year at this time. If you remember, rate cuts were expected in the very early part of this year at this time last year. Didn't materialize, and it's proven that inflation has just been more difficult to get under control. I think we're in the right trajectory for inflation, but I think getting down to that 2% level is going to take more time. And unfortunately, it's going to take some pain in the economy for us to get there.
And so, Megan, listen, if the Fed's higher for longer, we don't see cuts, at least in the near to intermediate term here, what does that mean for the equity market as we head into 2024, an election year, 12 months from now? Megan, do you see the SPX, the S&P 500, is it higher than we are here now?
I think by the end of next year, yes. But what I think is there's some, I guess you could say, recency bias with investors. First of all, they're very used to the Fed coming in and saving the day and cutting rates whenever there's any sign of economic weakness. That's not the case that I think going into next year. The Fed's going to have to remain higher for longer. And that's an environment that we're not used to seeing. Let's remember, from an equity standpoint, we're in a positive seasonal period right now as well. So I don't doubt that we can still have some upside here. But things are going to get really challenging as we go into next year. Not only is the economic situation very unclear, but you also have earnings expectations for next year and 2025 that we think are just too optimistic. They're going to have to come down. So when you get a realization that rates are higher for longer, you could see PE multiples contract, and then the earnings component of that as well is something that I think is going to come down.
So what do you do then, Megan, in terms of positioning? Do you get more defensive? Because some of those traditionally defensive groups also happen to be interest rate sensitive.
Mm-hmm. Yeah, so it's you have to be a little bit, I guess you could say, careful. There's, active trading here, active portfolio management. This is the best time to do that. Right now, from an overall portfolio positioning, we're neutral on our global equities. We have been reducing an overweight throughout this year because mainly the fact that we think investors are too optimistic on what the Fed can do. So we're sitting neutral, and we're not underweight because, to be honest, we are either, whether the last hike was in July or they have to go one more time, we are towards the end of this, the aggressive part of that rate hike. So they're behind us. So we want to stay neutral. From a fixed income perspective, we don't want to go out super long yet. There's a lot of complexities in the long end of the curve. We've talked about it earlier with the auctions as well, that these are something, today's was good, but this has been really market moving the past few weeks when it comes to the auction perspective. And then, when we look, we want to have cash. I mean, cash is a good thing to have in this environment. You can keep that short duration, earn some nice income here at this very short end of the curve, and then have that cash to be able to put to work when you do get that weakness and volatility. And we do expect that in the first half of next year.
Megan, good to see you. Thanks so much for spending a little time with us today. Megan Horneman.